There are five reasons why a deal may fail. I've spoken about those before, and today I will go a little bit deeper on one of them, namely the capital stack, which is the structure of how a deal is funded. But before we dive in, for those who may be tuning in for the first time or meeting me for the first time, my name is Bessie Kapurian. I spent majority of my career in risk management and underwriting as a commercial lender, working with founder-led enterprises on a variety of facilities, so advising founders, owners. I also started investing initially on the side, and now I have my own portfolio and help other investors do the same, particularly those looking to diversify into real estate, and help them with the due diligence, deal vetting process as well. And today, where I spend most of my time is not only consulting private investors and high net worth individuals, but also family offices, founder led enterprises on risk management, due diligence, strategic investments, governance, and such. So, without further ado, let's dive into today's topic, which is the capital stack. So, think about the capital stack about in terms of different layers or different sources of capital, and how the deal is structured. And each layer comes with its cost and benefits, right? At the top of the stack, in terms of priority and seniority, you have the senior secured lender. Then you may have other credit tranches like senior second lien lender. There may be even mezz debt, which would be unsecured, in many cases, unsecured creditor. So that's on the debt side. So lowest return, they basically make a spread on the interest, maybe some fees, but also in exchange, they also get the first priority in terms of payment. Then you have the equity stack, and within the equity stack, there is preferred equity, which sits ahead of other equity holders or ahead of the common equity holders. Typically comes with a certain rate of return, in many cases fixed, right? And some of it is paid throughout the cycle of a deal, and some of it, and then the rest accrues, typically paid at the time of exit if the deal performs as intended. But the upside is capped, right? In exchange for that, they get a higher priority in the capital stack. And then at the bottom of the pyramid, if you will, are the common equity holders. Now, bottom of the pyramid in terms of priority, but because they're taking on the most amount of risk in a deal, they also have the potential for making the highest return. Again, if the deal performs as expected. And so there is also in within that the sponsor's own co-investment, right? And that would typically come into that common equity stack. And so each piece sits in a very defined position with defined rights, returns, and obligations, as I've explained. And all that works great when each party of that capital stack arrives as expected, with the full commitment or full amount expected, and stays in place throughout the life cycle of the deal. And during the boom, the capital stacks were rarely stressed. Why? Because capital was abundant across all fronts. First, on the lending side, and in many cases, lenders were very, very aggressive, right? In term with their term sheets, in terms of pricing, structure. In many cases, both. On the equity side, uh, LP capital was abundant. Deals were filling very, very quickly, and often LPs had to get on a wait list. They couldn't even get into deals fast enough. And all that worked because the market was strong, the cost of borrowing was low, the cost of capital was low, capital was abundant. There was a lot of liquidity, especially post COVID, at the personal and corporate level. But all that changed in early 2022 and really exacerbated going into 2023. Senior lenders tightened their sizing, and a lot of it was predicated on the declining at the time cash flow. LP groups slowed the wiring of funds. For some, it was a timing issue, but for others, they started getting hit with capital calls, perhaps not so great news that their deal may not be going as great, or the worst news that their capital is gone. And sponsors who had structured deals around that stack that depended on multiple sources discovered that not every source would deliver on schedule, or at least not according to their original projections. Some of these capital sources delivered partially. Maybe the lender came through with the commitment, but lower than expected. Maybe the raise came in a little bit lower than expected, and they had to bring in a preferred equity partner to fill in the rest. And so some delivered, and a third did not deliver at all. And so the deals most exposed to these were deals that had closed with very thin coverage between the projected capital needs and the committed capital. And a deal that closes with just enough capital to close the deal is basically one surprise away from a capital call, or even worse, default. And maybe three steps away from foreclosure, which is even worse. And that pattern can compound quickly, whether that's the raise came in lower than expected, and the cash flow that they thought may bridge the deal wasn't enough. Perhaps the reserve cushion was already thin, and frankly, in many deals, especially today, the amount of reserves raised is minimal to none. Maybe operations encountered a setback that required additional capital. And then in that case, typically the sponsor would go back to passive investors and initiate a capital call. Some LPs may participate, some may not. And if the capital call falls short, that's a problem, especially if the sponsor is not well capitalized and on their own balance sheet and has no other sources of liquidity. Then you get senior lender notices, right? You may have covenant defaults, which are performance defaults. And then when the cash flow bucket is no longer full and liquidity is depleted, then defaults, payment defaults start happening. And maybe do another capital call, which doesn't work. I've spoken to many LPs, right, who are in deals that have gotten um, multiple capital calls at this point, and in some cases, unfortunately, that's not enough to save the deal, and it goes to foreclosure, so the LPs lose their capital, and that's the worst outcome, right? Losing the principal. It's not necessarily pause distributions. It's not, oh, the refinance did not come as expected, so the cash out didn't happen, or we didn't perform as expected, but we still gave you a positive return. Yeah, of course, meeting or exceeding projections is wonderful, but that doesn't always happen, and any of these circumstances are much better than a total loss of capital, including capital that was really sent in good faith, and really in situations where there was legitimate fight to save the deal. And so the structural lesson is straightforward to state and to apply. The capital stack on the offering memo is effectively a projection. It's basically at closing. It tells you this is what exists today, but these are not the same things, and LPs need to know the difference before committing. And so before evaluating a deal, the questions are very simple. What is the total capital required to operate this deal if things don't go as planned, and if there are adverse conditions, not just the minimum required capital needed to close? how much of that capital is committed in writing with signed documents before closing? Because again, um, until it's committed, there's no certainty that it will come. And even then, I would even go further and ask how much of that has been collected, right? And lastly, what is the portion of expected, but what happens if the that portion of expected but not committed capital does not arrive on schedule? What is plan B? Are we walking away from the deal, or are there other resources that you can bring to the deal and the capital stack? And how do those additional layers, if different than common equity, impact the deal, impact the control on the deal, impact overall returns? And so a sponsor who has thought through will have very specific answers. This is our goal. This is plan A, plan B, plan C. And how they respond will really give you a good indication of how well thought out that process is and the potential impacts on a deal. So then you can take a step back, right, and make an informed investment decision. Am I comfortable with what I see today and with the contingency planning that the sponsorship team has developed? I actually cover the capital stack in a little bit more detail in my latest book, The Busy Professional's Guide to Passive Apartment Investing. I will put the link in the comments. And I pop in to do these live events about once a week, Thursday or Friday afternoon, discussing topics on passive investing, due diligence, risk management, governance. And if you'd like to be notified of those, I encourage you to subscribe or follow that ring button or ring bell on my LinkedIn and YouTube profile, so you are notified. And let me know, what was your one takeaway from today's talk? I would love to know. And if you have additional questions or comments, please add those in the chat. All of these topics are coming from conversations with you. So I appreciate you, appreciate your time today, and I wish you a beautiful day and a beautiful weekend. Ciao.